What's going on, everybody? This is Joey from Universal CPA Review. In this video, we're going to talk about segment reporting requirements per United States Generally Accepted Accounting Principles. If you're studying for the CPA exam, this is one of those areas that can be sneaky challenging to remember because there are a few specific rules that we need to hammer down. And before we get started, just a quick reminder to subscribe to our YouTube channel. Also, feel free to join our Facebook groups. And if you really find this video helpful, don't forget to share it with your friends and invite them to our Facebook groups as well. Okay, because the more the merrier. If you consider yourself more of a visual learner, Universal CPA Review might be for you. Our program offers bite-sized video lectures that come with systematic problem-solving approaches that can really provide you with a roadmap for digesting these complicated topics. In addition to that, we're the only CPA Review course that offers video explanations on every single multiple choice question. So if this sounds like something you're into, feel free to use discount code UNIVERSAL2021 for 25% off of any of our products. All right, let's get started. ASC Topic 280. What does ASC stand for? That's the Accounting Standards Codification, right? Just thought I'd catch you napping. Let's talk about some segment reporting. So we think about segment reporting. We're thinking about a company that has either multiple business lines, product lines, or geographical areas. So the reason that this is tested in the FAR exam is because public companies require that the reporting of different segments exist in the consolidated financial statements. All right. So primary users, who are primary users again, investors, creditors, lenders, not regulators, are reading these financial reports. This is sometimes referred to as the 10K. What they'll see in this 10K report is not only the parent company, but a breakout of the different business lines or product lines or geographical lines, right? AKA the breakout of different segments. So the whole idea here is that they are displaying them in this sort of separated way. Okay, so financial statement readers are now able to understand the different segments, and the chief decision maker, also known as the CEO, can make decisions as to how they want to proceed with this segment, right? Do they want to keep it? Do they want to drop it? Maybe they want to allocate more money to it so that they can perform better. Okay, so that's something to note as it applies to publicly traded companies. If for whatever reason something indicates that the question is a private company, you could go ahead and ignore this, all right? So ultimately, there are three focus areas for this module that you need to hone in on. We want to know what is an operating segment, which segments must be reported, and this is going to be the most important, and what information must be disclosed. Okay, so let's say that Alphabet Corp owns 4 different segments, A, B, C, and D. And assuming that all 4 of these are different business lines, the whole idea here would be to break these out to better distinguish things like product line revenues, what are profits, and what are assets for each individual segment, right? Each of these need to be disclosed. So instead of looking at the total revenues, the total profits, and the total assets of this parent company, by breaking these out into each respective segment will allow financial statement readers to better understand the revenues, profits, and assets that each respective segment is claiming. So if, for example, segment B is dominating 90% of the company in revenues and profits, isn't that something that the financial statement readers would want to see? So the primary objective of segment reporting is to provide financial statement users information so that they can 1, more accurately understand the company's performance, 2, more accurately assess possible future cash outflows, also cash inflows, and 3, make more accurate judgments and decisions about the entity as a whole. So we'll talk more about what needs to be disclosed in detail, but for now, understand that all operating segments, any major products and services, geographical areas, and any major customer that the company might have needs to be disclosed. Okay, so at this point, we understand that this more robust and comprehensive segment reporting disclosure is going to help financial statement readers better understand the company as a whole. All right, so this is going to allow for analysts to have a better ability to forecast company revenues, margins, and total assets. All right, so this is going to help serve as a basis for valuing the company in the event that they ever want to sell it. Okay, so what are the key characteristics that describe a segment? So in order to be an operating segment, it must have the following characteristics. It must engage in business activities from which the company earns revenues and incurs expenses, right? If it walks like a business, talks like a business, then it's going to be reported like a business. Operating results are reviewed by the organization's chief operating decision maker, sometimes known as the CODM, often referred to as the CEO. As long as this information is reviewed by the chief decision maker, right, the head honcho, then this would be considered within the criteria of a reportable segment. And finally, financial information must be available. So we have to be able to distinguish the relevant financial information for each respective segment. So if we can't distinguish revenues from company A, B, C, and D, then we can't consider each of these a segment. So what is not considered a segment? Something like a cost center is not going to be considered a segment, right? So this could be something like the company's HR department or IT department. Okay, these departments do not have their own revenue, their own profits. They certainly don't purchase their own long-lived assets. Okay, so at the end of the day, this is what is key to understand when it comes to differentiating what is a characteristic of a segment versus what is not considered a reportable segment characteristic. Okay, so question number 2, which segments must be reported? So this is going to be the most important takeaway from this segment reporting topic and something that you absolutely need to know. So we need to understand, when is something going to be reported as its own segment? When are we going to break this out? Okay, so what are we going to do when things get tough? We're going to build some mental maps. So the question at hand is, at what point is the segment important enough that it needs to have its own separate disclosure? Okay, so for the exam, at the end of the day, you got to know the big 3. And what I mean by that is the 3 10% tests. After the big 3, we need to understand the 75% test, but we'll get there when we get there. Okay, so let's start by understanding the 10% tests. So we're going to go down the line and check off the boxes, right? At the end of the day, we need to meet just one of these 3 tests. So our 3 tests will consist of the 10% of revenue test, the 10% of profit and loss test, also known as the 10% of operating income test, and finally our 10% of asset test. And collectively, these will be referred to as the 10% size test. Essentially what we're asking ourselves here is, are any of these segments big enough that we should break them out and report them as their own separate segment in the financial statements? So when it comes to the 10% revenue test, we're asking ourselves, does this segment make up over 10% of the total revenues that the consolidated company has? And something sneaky to keep in mind here is that the segment revenue will include both internal sales and external sales. So what do I mean by that? I mean that that's going to include both sales made to third parties as well as intercompany sales, right? Once again, if our friends over at Oops Inc. are vertically integrated and they make sales to the manufacturing facility that they own, that's going to be included in the 10% segment revenue test. Okay, so that's the sneaky caveat related to the 10% revenue test. How about the 10% profit or loss test? And as we said, sometimes referred to as the operating income test. This one is probably a little bit more challenging, and the reason is going to be because we're going to be taking the absolute value of the segment profit or loss. Okay, so I'll say that again. We're going to be taking the absolute value of the segment profit or loss when comparing to the 10%. And that 10% is not just going to be the 10% of total profits. We're going to be comparing it to 10% of the larger of the combined profits of all profitable segments or the combined losses of all segments reporting a loss. So we're first going to need to calculate the total profitability of each segment, right? Let's say we have 6 segments. And let's say that 4 of which are profitable and 2 are reporting a loss. Now we must determine what is the larger of the 2. So this is step 1 in the profit or loss test. And it's now in step 2 that we're going to be making the 10% determination. Then we're going to go down the line for each segment and say, okay, is the profitability or loss that this one segment is reporting greater than or equal to 10% of the larger of these 2 amounts? Okay, and if that is still a little bit confusing, just hang tight because we're going to go through an example with some real numbers and it's going to make a lot more sense. Okay, so third and final 10% test is going to be the 10% of total assets test. Okay, so all we're saying here is that if the segment assets are greater than or equal to 10% of the total segment's assets, then this is going to be a reportable segment. So this is probably the least difficult to comprehend. Unlike the first and second test, there are no caveats here. So at the end of the day, if any segment reports revenues, profits, and assets that make up 10% of the consolidated company's revenues, profits, or assets, then that would mean that this is classified as a reportable segment. Okay, but think of it this way. This is really only a screening process, right? Once they've met this 10% test, that doesn't mean that we're done testing. It just means we now need to test for the 75% sufficiency test. Okay, so essentially this is going through a prelim round. Now it must pass the final test. So once we have determined the reportable segments, as long as they meet any one of these 3 10% tests, they're technically reportable. Okay, but the additional requirement is that the combined segment external sales must be greater than or equal to 75% of the total external sales. All right, so if you're sitting there, you're thinking, what? Don't pull your hair out. Okay, bear with me. We're going to break this out. And we now have a general idea of what is being considered a reportable segment. But that's not the end of the road in our mental map. We must find the brain stamina to go back and refocus our attention on external sales. Right? Again, we must remember this isn't internal sales. This is not intercompany transactions. This is external sales. This is a sale made to a customer. Okay, so company A is making a sale. It must be to a completely different company, right? They must sell to somebody like Joey's Pizza. Joey's Pizza is not a segment within Alphabet Corp. So once we have met the 10% test, then this is going to be considered a reportable segment. But once again, it must meet the combined segment external sales test. So all of these quote unquote reportable segments must report external sales that are greater than or equal to 75% of the total external sales. And what happens if they don't meet this 75% sufficiency test? Do we just not report each of these segments separately? Do we just completely nix the entire exercise? No, we do not. What we're going to do is continue to add segments until we do meet that 75% threshold. Okay, so if 2 of the 6 segments meet one of the 3 10% tests, but collectively the external sales of these 2 segments is not greater than or equal to 75% of the total external sales of all 6 segments, then we simply need to keep adding segments and breaking them out until we do meet that 75% threshold. All right, so if you still think this scenario is tricky to understand, don't completely freak out. If it's not clicking, we're going to go through an example right now. Okay, so we're now taking a look at this example of our very creatively named Alphabet Corp. And Alphabet Corp has 4 segments, also creatively named A, B, C, and D. So we want to determine which of the following 4 segments would be considered reportable segments. All right, so in order to be considered reportable, they must first meet the 10% test. All right, so there are 3 sub 10% tests within our 10% size test. Okay, so we have the 10% of revenue test, we have the 10% of total profit and loss test, and we have the 10% of identifiable asset test. Okay, so therefore, segment A, B, C, and D must meet one of these 3 tests to be considered a reportable segment. All right, so this is step 1. Okay, so let's fire this off by thinking about the 10% of revenue test. So something very important to keep in mind is that when we're talking about the 10% of revenue test, we're going to be including both revenues from outside sales as well as intercompany sales. Okay, so that's going to be very different from the 75% sufficiency test, right? We'll get there when we get there. But keep in mind now for the 10% test, right, in step 1, we're going to be including both of these sourced revenues. All right, so when thinking about the 10% of revenue test, the first thing we need to do is add up all of these segment revenues. Okay, so A, B, C, and D have a total revenues of $650. Okay, so 10% of $650 is going to be our reportable threshold. Okay, so $65 is the amount that needs to be exceeded in order to be considered a reportable segment. Okay, so taking a look at our segments, segment A and segment C are both going to have revenue in excess of our $65 threshold. Okay, so $300 is greater than 65, and so is $250. Okay, so segment A and C are reported, segment B and D are not. Doesn't mean that B and D are not going to be reportable, they're just not reportable under the 10% of revenues test. Okay, so boom, 10% of revenue test is done, but we must now apply the 10% of profit test, all right? So 10% of profit and losses is going to be box 2 of our 3 boxes that we must check off. Okay, so something very important to keep in mind is that we need to calculate the absolute value of the combined operating profits of all of the different segments that are being reported, all right? So any segment that is reporting a profit or a loss is what is being compared to the 10% of profit and loss test, right? But keep in mind, this is going to be the absolute value. Okay, so if we think about this, the total amount of total segment profit and losses is going to be irrelevant. So this $200 not going to be relevant. We can disregard it. Okay, so we're going to start by taking the greater of the 2 absolute value amounts. Right, so our profit amount is going to be $250. Segment A, B, and D are all reporting profits. And the sum of those profits is going to be $250. And the only segment that is reporting a loss is going to be segment C, which is a $50 loss. So therefore, we're going to compare 10% of the $250 to 10% of the $50. So this one's pretty straightforward. $25 is greater than $5. Therefore, $25 is going to be our 10% threshold. Okay, so now when we think about the reported segments, based on our $25 threshold, we need to ask ourselves which of these segments exceeds the $25 in the absolute value of profit or losses being reported. Okay, so that's going to be segment A, C, and D. Okay, because $190, $50, and $40 all exceed $25. Segment B is not going to be reportable under the segment profit and loss test because $20 is less than the $25 threshold. Okay, so 2 down, 1 to go. Finally, we have the 10% of identifiable assets test. Okay, so this one's also very straightforward, similar to 10% revenue tests, in that we're taking the sum of each of the 4 segments, which is going to be $240, and we're comparing this to our 10% threshold. And so therefore, 10% of 240 is going to give us a $24 threshold. And we can now very easily determine which segment would be considered reportable. Okay, so segment A, C, and D would all be considered reportable as they are all amounts that would exceed the $24 threshold. All right, boom, boom, boom. We've now completed all 3 of our 10% tests. And we see that segment A, C, and D would all be considered reportable because they all meet at least one of these 3 tests. Right, we see that segment A meets tests 1, 2, and 3. Segment C meets test 1, 2, and 3. Segment D met test 2 and 3, okay? Whereas segment B didn't meet any of the 3 10% tests. So we now know that 3 of the 4 segments are going to be considered reportable. But in order to actually be reported, they must now also meet step 2, which is the 75% sufficiency test. So more specifically, this is the 75% of consolidated revenues test, all right? So the key to keep in mind here is that reportable segments must have unaffiliated revenues of at least 75% of the total consolidated revenues. So you might be thinking, I thought we already did the 10% of revenue test. Why are we comparing revenues again? So the key difference here is that we are excluding all revenues from intercompany transactions. Okay, so we're going to be focused only on revenues from unaffiliated customers. Whereas if you remember back in the 10% of revenue test, we also included intercompany transactions. We're not doing that anymore. Okay, so we know that the total consolidated revenue for all 4 segments is $650. We now know that the total revenue from unaffiliated customers was $580. So what does that tell us about intercompany transactions? That's going to be the difference of $70. This is the amount that we can ignore when we are comparing our 75% threshold. Okay, so we're going to focus on revenues from reportable segments that are from unaffiliated customers. So our reportable segments are A, C, and D. So therefore, we're going to sum up 280 plus 200 plus 50. So we have total revenues from unaffiliated customers from reportable segments in the amount of $530. So we know that our total revenues from unaffiliated customers was $580, but our total revenues from reportable segments from unaffiliated customers amounted to $530. So what we now need to determine is if $530 makes up at least 75% of the total consolidated revenues. Okay, so we're going to divide the 530 by the 650, which is going to give us 81.5%. So that does tell us that yes, indeed, the total revenue from unaffiliated customers from reportable segments does exceed 75% of total consolidated revenues from all segments. All right, something else that is sneaky to keep in mind that they might throw your way on the exam is that if the 75% test has not been met, then we must keep adding segments until it has been met. Okay, so key takeaways here is that we must first meet the 10% size test. Okay, so they must meet any of the 10% of revenues test, 10% of profit and loss test, and the 10% of assets test in order to be considered a reportable segment. And then after that, they must meet the 75% sufficiency test. This is step 2. So we must remember that this is not going to include intercompany transaction sourced revenue. We're going to take the total unaffiliated sourced revenue from reportable segments. We're going to divide it by the total consolidated revenue for all segments and determine whether or not it exceeds 75%. Okay, so these are the tests that must be met for segments to be reported in the complete set of financial statements. All right, the third and final question we need to cover when it comes to segment reporting is what information is being disclosed. Ultimately, we need to know what related to our 3 10% tests needs to be disclosed, right? What related to revenues, profit and losses, and total assets will need to be disclosed by interested readers. So when it comes to revenue, we need to disclose things like sales that are being generated from intercompany transactions or intersegment transactions. Okay, so if one segment is making a lot of sales to another segment, that needs to be disclosed to financial statement readers. Okay, so while a lot of the revenue items need to be disclosed, if the majority of sales are made to external customers, disclosure is not going to be as critical. Okay, so some other items such as directly traceable expenses, interest revenue, interest expenses, things like depreciation and amortization, right? When it comes to profit and losses, certain additional disclosures need to be made, right? What about a major expense such as the compensation of an officer, right? What if Alphabet Corporation's chief decision maker has a compensation plan that comes from all of its segments? Then we need to determine where this expense is going to be allocated. If it's 25% across the board, A, B, C, and D, let's say, then we would allocate 25% of this person's compensation to each of these segments. Okay, so all we're saying is that if these items are allocated to more than one segment, then ultimately the following items must be individually disclosed. Okay, so some additional items need to be disclosed as well, such as equity and net income of investees, assuming the equity method is used, as well as any significant non-cash items. So that is what is included for disclosure. What items are excluded from segment reporting? Some of the miscellaneous items, right? Income taxes, general corporate revenues, general corporate expenses, equity and earnings and losses of an unconsolidated subsidiary, things like gains or losses from discontinued operations, as well as non-controlling interest. All right, so anything you see related to equity method, non-controlling interest stuff, we're going to talk about this in later modules. Okay, so something additional and maybe miscellaneous to note is that intercompany transactions will not be eliminated when consolidating the parent company. Okay, so if Alphabet Corp is consolidating its financial statements with its various segments, then we're not going to eliminate the intercompany transactions. All right, we have a whole section on intercompany transactions, so if this seems a little bit crazy to you right now, don't get overwhelmed. Keep in mind that intercompany transactions made between segments are not going to be eliminated when consolidating these financial statements. Okay, but most importantly, we need to know this question number 2. We need to know our 3 10% tests, and then subsequently we need to know how the 75% sufficiency test will apply. Okay, so now that we have a fundamental understanding, let's go back and let's apply this and practice it some more.